Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening in the Chinese economy, and specifically to talk about the Chinese stock exchange. If you've been following the channel, you'll know that 2023 has proven to be a very difficult year for China. At the beginning of this year, expectations for economic growth were high. China had finally removed all of its COVID-19 restrictions in December 2022, and it was expected that the Chinese economy would deliver more than 6% growth. However, as you'll have seen if you follow the channel, the last 6 months have proved to be a very difficult period for China. Exports and imports are both down significantly, and the ongoing problems in the property sector are still causing the economy major issues. And in today's video, I want to look at what's happening with the Chinese stock markets, because obviously as the economy has slowed down, the value of Chinese companies that are listed in both China and also Hong Kong has come down as well. And this is now causing major concern, particularly because over the last few years, the popularity of a structured derivative financial product called SNOWBALL Products has been growing. And it's now been reported that if the Chinese stock market continues falling, there is around $27 billion worth of these products that will be triggered, which will crystallise a huge loss for all of the investors and potentially could cause a further run on those shares. And as a result of these risks, the Chinese authorities have been stepping up their level of involvement and are now actually looking to invest directly into the stock exchange. And this is basically a form of market manipulation that we don't see in any other country in the world. So in today's video, I'll have a look at Chinese listed companies, the Chinese stock markets, and how big they are in comparison to other markets in the world. We'll then talk about these SNOWBALL products that have been created in China and what the risks around them are. We'll have a look at the proposed levels of market manipulation by the Chinese authorities. And then finally today, I'll wrap up with my summary as to what I think is likely to happen in the Chinese stock markets over the course of the next 3 to 6 months and what the risks of this are for the global economy. But before we get started on all of that, once again, I'd like to say thank you so much to everybody that's bought me a coffee or sent me a YouTube super thanks. Really appreciate that. Thank you. And if you'd like to support the channel, please have a look below where you'll find links to my Patreon channel where you can see more face-to-face videos and avoid the adverts that you get on YouTube, as well as buy me a coffee and YouTube super thanks and membership scheme. The history of share trading and stockbroking in China dates back more than 130 years. And in 1891, the Shanghai Sharebrokers Association was established in Shanghai, along with the Association of Stockbrokers in Hong Kong. In 1904, the Chinese stock market was officially renamed the Shanghai Stock Exchange, and this remained as the biggest market in China for the next 45 years. However, following the establishment of the People's Republic of China in 1949, the exchange was closed to foreign investment. The market started to reopen to the outside world in the late 70s and 1980s, and on December 19, 1990, the Shanghai Stock Exchange formally reopened its operations to the rest of the world, alongside a second exchange for smaller and medium-sized enterprises based in Shenzhen called the Shenzhen Stock Exchange. And in September 2021, Beijing also launched the stock exchange covering smaller and medium-sized enterprises. Alongside the 3 exchanges based in mainland China, China also utilises the Hong Kong Stock Exchange, which was founded in 1891. And unlike the Chinese stock exchanges, which do have limitations in terms of the amount of overseas investment, the Hong Kong Stock Exchange has been open to foreign investors throughout the whole of its lifetime. Buying shares of publicly traded companies in the People's Republic of China is not quite as simple as buying stocks and shares in other countries. While shares on most public markets around the world are generally available to anyone that has the money to pay for them, the Chinese stock markets have strict restrictions on who can buy and what is available to them for purchase. Publicly traded companies in China generally fall under 3 share categories. Chinese A shares are the shares of incorporated companies based in mainland China that are listed on either the Shanghai or Shenzhen stock exchanges. A shares are issued in China under Chinese law and are quoted in Chinese yuan. A shares are generally only available for trading to mainland Chinese citizens. It's technically possible for overseas investors to invest into these companies, providing that they are officially qualified as foreign institutional investors. However, only a select group of institutional investors have qualified for this status and can buy and sell Chinese A shares. B shares are shares in Chinese companies that are quoted in foreign currencies, such as the US dollar or the Hong Kong dollar. These shares are listed on the Chinese stock markets, but are freely available to foreign investors. 8 shares represent the shares of publicly incorporated Chinese companies that are listed on the Hong Kong Stock Exchange. The shares are issued in China under Chinese law and are subject to the Hong Kong Stock Exchange's listing requirements. 8 shares are quoted and trade with a face value in Hong Kong dollars and are open to all overseas investors. This graphic, produced by Visual Capitalist, shows the 25 largest stock exchanges in the world by market capitalisation. And basically how this has been put together is by showing the market capitalisation of all the shares listed, so basically adding up the value of all of the companies listed on that exchange as at the end of August. And as you can see from the size of these bubbles, the largest stock exchange in the world is the New York Stock Exchange, which has a market cap of around $25 trillion. Followed by the Nasdaq in the USA, which has a market cap of around $22 trillion. Euronext, which is based in the Netherlands in Europe, which has a market cap of around $7 trillion. The Shanghai Stock Exchange in China is the 4th largest stock exchange in the world with a market cap of around $6.7 trillion. Japan Exchange Group is number 5 with a market cap of around $6 trillion. Followed at number 6 by the Shenzhen Stock Exchange, which is also in China, which has a market cap of around $4.5 trillion. The Hong Kong Stock Exchange comes in at number 7 with a market cap of around $4.2 trillion. The National Stock Exchange of India is number 8 with $3.5 trillion. The London Stock Exchange in the UK is number 9 with a market cap of $3.4 trillion. And the Saudi Exchange in Saudi Arabia is number 10 with a market cap of $3.1 trillion. And in terms of how the markets have moved over the last 7 years, you can see that the total market cap of these 25 exchanges in 2016 was $69 trillion, compared with $110 trillion today. And in terms of the global split, 47% of that market cap is based in the Americas, 29% is in the Asia Pacific region, and 24% in Europe, the Middle East, and Africa. SNOWBALL products, which are also called SNOWBALL Structure Income Certificates, are a type of complicated derivative financial instrument that were created in China in 2010. The market for SNOWBALL derivatives was mainly limited to institutional and fund investors for the first 10 years. However, as these derivatives offer bond-like coupons to investors, they started to become more popular, and in 2021, as the pandemic and weak economy forced brokerages and investors to get more innovative, they gained in popularity, and it's now estimated that a significant fall in the stock markets in China could result in losses of around $27 billion for holders of SNOWBALL products. Many of these derivatives offer returns of between 15 and 20% to investors, and the structure of these deals is similar to option contracts, where you place bets on what will happen to the share price of underlying companies. However, the key difference with SNOWBALL contracts compared with options is that a SNOWBALL contract has 2 defined prices, called the knock-in price and the knock-out price. The knockout limit is the upper level of the share price, and if the underlying share price rises above this trigger point, then investors are taken out of the contract and paid off. However, the risk in the contract from the investor's point of view is the knock-in price, which is the lower limit that is set for the movement of the shares. And if the share price falls below this level, often set of a level of around 20 or 30% below the current share price, then this will crystallise a loss for investors. And this chart shows an illustration of how snowballs work. Now please accept my apologies if you don't read Mandarin. I don't either, but you don't need to be able to understand this chart. This chart shows the movement in the share price of the underlying asset that a snowball contract has been structured around. The scale on the left hand side shows the share price in Chinese yuan. The blue horizontal line around 2/3 of the way up this chart shows a share price of 100 Chinese yuan. The dotted line at the top of the chart shows a share price of 103, representing an increase of 3%, and the dotted line at the bottom shows a share price of 75 yuan. And the red line on this chart shows the movement in the share price over time. Now, under the terms of this snowball contract, an investor would receive a return of 20% over a 12-month period, providing that the share price, which is at 100 at the start of this contract, does not increase by more than 3% and does not fall in value by more than 25%. So the contract has been structured to provide a high yield to investors if the share price moves very little in value over the next 12 months. So it provides a nice return in the event of a flat market. If we now have a look at the movement of the red line, the red dots represent the monthly testing period, following which income would be released to the investor. So if we look at the movement of the red line, you can see that on the first testing date, the share price has risen to around 101 Chinese yuan. So that doesn't represent the knockout value of 103. And therefore the investor would be paid their monthly interest because the share price is moving within the parameters that are agreed. On the second testing date, the share price has fallen back to 100, so the investor again would get the monthly interest. On the third testing date, the share price had fallen to around 85 Chinese yuan, so again within the agreed parameters, so the investor would receive their monthly payment. On the fourth testing date, the share price had fallen to 75 Chinese yuan, which is at the very lower limit of these parameters, so the investor would once again receive their yield. However, on the fifth testing date, the price had fallen below 75 yuan, and as this price is lower than the agreed parameters, this would represent the knock-in value and would crystallise a loss for investors. And just to provide you with a full explanation of how the snowball works in the event of share prices rising, if we ignore the drop in value in month 5, if the red line had stayed within the parameters, on the right-hand side of this chart, as it goes above the 103 level, that would actually represent the knockout value and would actually have led to a termination of the contract. The investor would be paid in that month, but the contract would no longer continue as the share price had risen above the upper limit of the snowball contract. So just to give you a real-life example, if an investor invested in the China Securities 500 index with an initial price of 7,000 points and an investment amount of 1 million Chinese yuan, subsequently, the market fluctuated wildly and the CSI 500 index dropped to 3,500 points. This would trigger the knock-in effect and the investor would bear a 50% loss, which in this example would be 500,000 Chinese yuan. In August, it was announced that China's security regulator approved the launch of 37 retail funds as part of a government initiative to revive the stock market. The newly approved funds will inject capital into the Chinese markets in the form of 10 ETFs, or exchange-traded funds, that track the small-cap CSI 2000 index, 7 tech-focused ETFs, and the remaining 20 products are innovative mutual funds that for the first time charge investors floating fees to be pegged to fund size, performance, or holding period. The Chinese regulator has also vowed to fast-track ETF approvals and guide asset managers to lower management and trading fees, along with several other market-friendly measures. Despite the announcement of this market support, the Chinese stock markets continued to fall. And within the last 2 weeks, the Chinese authorities have announced that they are now considering creating a state-backed stabilisation fund to shore up confidence in the equity markets. Financial regulators recently submitted a plan to the country's top leadership after at least 2 rounds of consultation with industry participants. The plan calls for the fund to have access to total capital of hundreds of billions of yuan, and this move comes after China's Big Four state banks recently announced that the controlling state parent shareholder, Central Huijin Investments, bought Shanghai-traded shares and plans to further increase its holdings over the next 6 months, which basically represents an injection of capital into all of these banks directly from the state. So basically what we're seeing here is market intervention. The Chinese authorities are very concerned about the falls in the stock market and are now looking to invest state capital into these companies to bolster their share prices. This chart shows the movement in the CSI 300 index, which is the largest 300 companies listed on the Chinese stock market, over the course of the last 5 years. What this shows is that the index rose from a low of 3,650 in March 2020 at the start of the COVID pandemic to a high of around 5,800 in February 2021. However, since that time, there has been a significant decline in the value of the CSI 300, and the current level is sitting at 3,560, which is lower than the trough seen at the time of the pandemic. And if we change the scale of this chart to show what's been happening over the last 12 months, you can see that this time last year, the index was trading at 3,500. However, by the start of February, it had risen to 4,200, and this was based upon renewed optimism for the Chinese economy for 2023. The COVID-19 restrictions were finally lifted after 3 years in December 2022, and economists at that point expected this to be very good news for the Chinese economy, and there were expectations at that time that China would achieve growth of between 6.5% and 7% for 2023. However, due to the combination of problems in the Chinese economy and a slowdown in the global economy, the uptick in financial performance was short-lived, and over the last 6 months there's been a significant decline in the value of companies listed on Chinese stock markets. Now, you may be looking at this chart and thinking, well, this performance is predominantly linked to what's happening with the Chinese property developers, because we all know that they are suffering badly. The Chinese property market is on its knees right now. Many of the big developers have run out of cash and are unable to access the large quantities of debt that they were able to access historically. However, this index is not heavily influenced by what's happening with the Chinese property developers, because the vast majority of those companies, such as Evergrande and Country Garden, are actually listed on the Hong Kong Stock Exchange, so are not included in this index. And if they were included on this index, then the decline that we've seen would likely be worse. So what's the summary and conclusion today? Well, I wanted to post this video really to give you an update as to what's happening in the Chinese stock markets, because most of the discussions that we've had about China have been focused in on what's happening in the economy, looking at exports and imports and the property developers and all of those big picture issues. But of course, the real life implication for a falling economy is that the companies that are based in that economy are likely to be reporting lower profits, and therefore if they're listed on the stock market, that will have a negative impact on their share price. And that's exactly what we saw in the stock exchange charts that we looked at earlier. Over the last 2.5 years, there's been a significant decline in the index, and that's now starting to cause major concern in China because of these derivative products called snowballs. Now, snowballs were invented to provide investors with a yield at a time of very little volatility, when nothing was really happening in the stock markets. But there is always a downside risk with any of these structured products, because if the markets move outside of the agreed parameters, that will trigger and crystallise losses for investors. And the problem that we've got is that a lot of these products look like bonds. So it looks like you're getting a nice healthy yield by investing into a very steady and boring portfolio of assets. But the difference here is that these aren't bonds. The risk that you're taking is linked to the share price of the underlying assets. And if you have a general reduction in share prices, as has been seen in China, because the whole economy is going into a slowdown, then very few companies will be able to escape from those falling prices. And what we're seeing now is that a lot of these snowball products are sitting on the brink of triggering these losses, which would have a devastating impact on the Chinese economy. Because as the brokers have to realise their positions and exit from their holdings, that's likely to cause a flood of sales in those stocks. And as we know from basic economics, if there's an increase in supply and not an increase in demand, that will cause prices to fall. And so there is a potential that there could be a run on the Chinese stock market, because as the brokers are forced to sell their positions, we could see hedge funds and other financial institutions deciding that they want to short those stocks because they think they're going to fall further in value, and that could lead to a collapse in those share prices. Now, obviously the Chinese authorities are aware of that type of risk, and they've now decided that they want to start investing directly into the stock market themselves. And as a direct result, a variety of funds have been set up to put money into the stock market. But as I discussed right at the start of this video, this is essentially a form of market manipulation. Stock markets should be an entirely free market, where the price of a company's shares is determined by supply and demand. So if a company is doing well, if it announces that it's had record profits or something really exciting is happening, then it's likely that that share price will go up because everybody wants to buy it. So as demand rises, so does the price. And of course, the opposite also applies. If you post record losses or something negative about what's happening with your business, then it's likely that shareholders will want to sell, and that causes a drop in your price. But what isn't generally allowed in stock markets is manipulation. Somebody buying shares to drive up the price. And in fact, if that's proven to be the situation, that can be a criminal offence. But the Chinese authorities obviously have a different agenda. They're looking to protect the value of Chinese companies and the Chinese stock markets. And as everything operates under Chinese law, this is entirely legal. If the Chinese authorities say that we're going to set up a fund to start buying shares in the stock markets because we're not happy that stock market prices are falling, then nobody is going to be able to stop them, because that then becomes Chinese law. But the reason I wanted to share this video with you is firstly to make you aware of what's going on, and secondly really to discuss this point, because I think it's really interesting that in any other market in the world, if your share price is falling, then the only way that you're going to be able to address that is by doing things that improve the attractiveness of your company, whether it be increasing profits or announcing new products or whatever it could be. But in China, the situation is slightly different. If your share price is falling, you may well get bailed out by the government deciding that they're going to come along and buy a big chunk of your shares, which boosts demand and potentially throws your share price up rather than pushing it down. And I think it'll be really interesting to see what happens over the course of the next 3 to 6 months, whether we see the Chinese stock market bouncing back, and if that's linked to what's happening in the Chinese economy, or if we start to see a disconnect between the markets and the economy. If the markets are going up but the economy is going down, then that obviously will ring alarm bells, because the stock market should be intrinsically linked to what's happening in the Chinese economy. So hopefully you found today's episode useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.